Rick, we're going to continue the conversation right now about CPI. I want to get everybody's take on what we're just hearing as it relates to this inflation data. Tiffany Wilding is the economist at Pimco. Emily Roland is the co-chief investment strategist at John Hancock Investment Management. Of course, our own Steve Leisman is here. Steve, I want to start with you and get your reaction to the number and maybe get inside the mind of the Fed as it's looking at this number this morning.
Well, I'll do that sequentially. Food was a goose egg. Energy down 0.8. I think we're going to get more of that given what's happened to the price of oil over the past month. Interesting, used cars down 1%. We thought they might level off here. New cars up at zero. Owner's equivalent rent, we can't get any help from. It's really quite a mystery. Up 0.5 again. This is the proxy that they use for housing costs. It doesn't seem to come down. I keep reading anecdotal reports about lower prices throughout the country, specifically places like Texas, places like Florida, and it's not showing up in the index. I don't know why. It continues to be expected to show up. One other thing was medical care services down 0.1%. There's an expectation that this is going to be coming back, and it had been down. Airline fares up 3.9%. I want to take a second to talk about this. There's a residual seasonality problem, or because the pandemic saw airline fares rise each summer, there's an expectation now that they'll continue to rise. The pandemic has messed up a lot of data, especially the seasonality aspect of it, the seasonal adjustments. We're going to be living with this for a while. Not sure how much airline fares have gone up. They tend to go down with energy. Real quickly then, as Rick pointed out, you have had a rise in yields. That shows up in the expectation for the Fed. So what's happened right now is that, and I think this is right, there was one chance, a small chance, that this data might favor a 50 basis point rate increase. It did not. If it was substantially lower, substantially below expectations, there was a chance it might favor 50. It does not. So what happened is you've had an increase in the probability of a 25 from 71 to 85%. And I expect with the PPI tomorrow, if it comes in around expectations, it'll lock in at 25 for next week.
Thank you, Steve. Tiffany, what was your reaction and take on all this?
Yeah, so I agree. I think this is probably this is a 25 basis point rate cut in September. It takes away some of the urgency that the markets were discussing around a 50. I think ultimately, though, the Fed probably had made up his mind. I don't think that the labor market report that we got a few weeks ago was weak enough for them to go. It wasn't great, but it wasn't weak enough for them to go 50. I think more likely what happens in September is they announce 25, but they make it very clear that they're going to do a sequence of rate cuts. Because relative to their own monetary policy rules, they look a little bit behind a curve. So they can, there's a range of possible outcomes here where it's appropriate for them to be cutting. So I think that's really the message that they're going to send.
Emily, your reaction and what you think the Fed may do?
Yeah, this was a good report. In fact, this was the fourth consecutive good report we got after three bad ones to start the year. You know, the shelter component here is a little bit worrisome. It's been responsible for 70% of the gains in CPI over the last several months. So the housing market's just been very stubborn here. But overall, the Fed's going to be a lot more focused on the labor market. I agree with Tiffany. Last month's job report wasn't great. The revisions were terrible. Job openings are at the lowest level since 2021. We're hearing respondents in surveys telling us that jobs are hard to find. And then we heard from Powell at Jackson Hole that the Fed does not welcome any more cooling in the labor market. So we think that the focus here shifts away from inflation towards the labor market. It's going to be 25 basis points in September. Bond market's loading up the rest of the year, 50 basis points expected in November, 50 in December. We think that's a little bit too aggressive here, given that inflation and shelter still have not come down.
Well, Emily,